despite all the craziness happening in the stock market lately, all the craziness happening with the VIX was over 30. The VIX has been over 30 now for over a week, which is very alarming, signaling a potential stock market crash in the not too distant future. If the VIX continues to head higher into the mid to high 30s, it could approach Lehman Brothers levels. And then the Fed's threatening of 1/4 point interest rate hike in March. We'll see if they actually do it or not. If they do actually do it, we are looking at the leverage short volatility trade. A lot of these over leveraged hedge fund trades from family offices, hedge funds, and portfolio managers at investment banks blowing up. So all these deflationistas that are leveraged bond fund managers, their trades that they're counting on probably won't go the way that they think they're going to go. Anyways, I wanted to talk about oil in this short little video. The oil price, and I put the chart there, the 1-year West Texas intermediate chart on the right-hand side of your screen. The oil price has been on a tear for the last 5 or 6 months. Really, the Biden administration attempted to manipulate the oil price down a lot by coordinating with 5 or 6 different governments and dumping the strategic petroleum reserves. That lasted for a little under 2 months. That managed to knock the oil price back down. But here we are, the oil price is rallying. It is now back above $90 a barrel. The oil price had a big pop on Sunday night, early Monday morning. And it looks like potentially we could get to maybe $100 a barrel in a month or less if things continue. And the oil price and the natural gas price are holding up very, very well despite the threat of interest rate hikes, despite the volatility and problems in the stock market. So in my opinion, this has more to do with supply and demand fundamentals for oil and natural gas. There was also at the end of last week, a very big short squeeze in natural gas. In my opinion, based on what I saw in the natural gas market here in the US with natural gas prices, a Chinese government shell company, after a lot of Chinese oil companies bought too much liquefied natural gas cargoes, and they were trying to temporarily dump them onto the market to knock the price down. Someone was greedy who had a lot of cash and not a lot of trading experience. My friend Aaron, who does This Week in Charts for me once a week, we discussed this before he put it out in the video. That's why he mentioned it. It looked like it was a government trader that they attempted to short the natural gas price last week a lot. It got the monkey hammer, and then there was an enormous short squeeze, and natural gas prices actually rose the most ever in a single day. So natural gas and oil look to be holding up very, very well, at least in the US dollar price. But the fundamentals for natural gas are actually very strong as well. There are supply problems for natural gas. There are shortages for natural gas and electricity in the United Kingdom, in the European Union, and in China still. China probably didn't want the natural gas price rising too quickly, but the amount of imports of natural gas and LNG into the European Union, there are stories on oilprice.com talking about how the amount of imports of liquefied natural gas and natural gas into the European Union is 5 times more than the amount that they used to bring in from Russia. So a lot of natural gas is needed for energy, electricity, fertilizer, so many other things in the European Union. There are big, big shortages. And American firms like Chevron, EOG Resources, Cheniere Energy have been big, big winners. Some of the laggards, some of these companies that have not done very well, some of these mid-tier oil and gas independents that have lagged compared to EOG Resources or Chevron, they could potentially become takeover targets here in the US in the next 6 to 12 months. I'd like to see Chevron and EOG Resources go out and do some acquisitions. Actually, over the last 6 months, ExxonMobil sold natural gas assets instead of trying to acquire more, although they've been investing more into offshore in their West African oil discovery, their massive one. But ExxonMobil has balance sheet problems with debt, so does Occidental Petroleum. Probably why Occidental Petroleum, after they bought Anadarko with so much debt, why that combined company, even though they have great assets, has not been bought. They still have too much debt right now on their balance sheet. And an acquiring company does not want to take them out. Anyways, besides just doing some normal oil market analysis, I wanted to talk about problems with the oil market. So you have these articles coming out with people who don't have as much experience in the oil market. My day job in the past in the financial industry, I worked with Robert Rapier over at Investing Daily. I was an oil and energy analyst. If you're not familiar, that was one of my day jobs in the past. We used to cover oil and natural gas stocks, MLPs, the large caps, the mid tiers. So I've covered a lot of these companies over the years. And unfortunately, the mistakes that are being made by politicians, bureaucrats, regulators in the United States, in the European Union, actually it's all over the globe, it's across the board. The policy mistakes are the problem. You see headlines, and I put the red square around there, about White House is considering more oil price controls. And these article headlines are that Biden desperately needs to bring down oil prices. Well, how's he going to bring down oil prices? They're not doing rational, common sense policy to actually help the economy if these politicians, bureaucrats, and regulators were not being overly influenced by their environmentalist base. And that's the main problem here. You have the Biden administration, you have the Democrats in Congress. They do not want to approve more oil and gas drilling. They do not want to approve more pipelines because their environmentalist base will not allow it, will vote them out, will replace them, will defund them. We'll make sure they can't get re-elections. We'll make sure that they don't get millions of dollars potentially in profits from these green energy companies that are all going to get unbidded ESG contracts from the Department of Energy, while the Democrats have a slight majority in both houses of Congress until the next congressional elections. So you have big policy mistakes. Common sense, rational policy to actually help oil and natural gas prices would be to allow more oil and natural gas permitting and drilling on federal lands with the Permian Basin in New Mexico, or to allow more pipelines here in the United States, allow more nuclear power plants to be built, those types of things. Rational, common sense to alleviate supply problems. Instead, you have politicians, bureaucrats, and regulators, because they don't want to do rational, common sense policy with energy and giving oil and natural gas companies the ability to increase supply. You have these politicians, bureaucrats, and regulators instead talking about more and more market manipulation, more and more price controls, taxing oil and natural gas companies, forcing them to invest in green energy, installing activist investors onto the board of directors, green energy, ESG activist investors. So these companies are forced then to allocate capital even more inefficiently, and it's just going to make an even larger mess of things. So unfortunately, things are going to get worse before they get better, and this is why even if oil prices keep rising, more and more supply may not come back online quickly. That and so much of the world's oil and natural gas reserves are not owned by Chevron, are not owned by ExxonMobil. They're owned by national oil companies. And I talked about this extensively for patrons. I spent about 5 hours worth of work on 2 extensive articles last week. One of the articles was talking about Pemex, which is Mexico's national oil company, and all the financial troubles and how inefficiently run Pemex is, and how their oil company is now causing enormous financial problems with the Mexican economy and the Mexican government. All because Mexico's oil company is not efficiently run, they're not making enormous oil profits, and they're not exporting oil for US dollars. And that is causing immense amounts of more problems throughout the Mexican economy. Finally, if you like content like this and want to help keep content like this free so it doesn't all end up behind a paywall, or you want far more in-depth content, research, financial education, and analysis than I provide in these short little free videos, there are now over 200 articles and audio podcasts behind my paywall, exclusive for my patrons, for only $5 a month. I think it is one of the best deals out there. And just in the last 27 or so weeks, there are now 41 new articles and audio podcasts, including 2 new in-depth articles that took me over 5 hours worth of work on a mining industry investing update with a lot of charts and analysis about where large mining companies, large and medium-sized mining companies, are now allocating their capital over the last 6, 12, 18 months. There's big trends now, and trends are shifting. Countries are changing their tax laws. A lot of it's based on the copper price. And then also one about how mining is not as safe in Mexico as it even was 3 or 5 years ago because of the amount of corruption increasing, and how desperate for tax revenues the Mexican government is now to replace lost oil tax revenues, even though the oil price is high because of how inefficiently run Pemex is, which is their national oil company. There's also audio podcasts about the uranium market over the last 5 or 6 weeks, 2 audio podcasts with uranium market updates. And I suspect in the next week or two, there will be another oil and natural gas, either article or audio podcast out for patrons, all for only $5 a month. So if I could wrap up this short little video very quickly, policy mistakes are the main problem. You have politicians, bureaucrats, and regulators for oil and natural gas here in the United States. They're making it more and more difficult for oil and natural gas companies to increase supply. It is very inefficient. Tax laws, rules, regulations, red tape, even getting permitting. Some of the best drilling areas are on federal lands, the Permian Basin in New Mexico and others, and it is becoming more and more difficult for a lot of oil and natural gas companies to increase supply here in the United States. If oil prices do go higher, if Congress does not change to majority Republican, the oil and natural gas companies could potentially be looking at much, much higher taxes, some type of punitive tax for oil and gas. But these governments at the state and local level and European governments, I'm seeing absolutely crazy gasoline prices, people posting absolutely crazy prices for gasoline by the liter in Europe. It's insane how high it is. These governments are taxing these oil companies more and more and more. The governments are actually making more money per gallon or per liter of gasoline than these oil companies are, than the owners of the gas stations are. That is something that is not talked about. What is also not talked about is how governments, through these national oil companies, own the majority of oil and natural gas reserves, and they're the ones that cannot efficiently increase oil and natural gas production. That's the main reason why we have supply problems, not because Chevron and ExxonMobil are evil and greedy. It's because the majority of the world's oil and natural gas reserves, I think it's 70% or more, are owned by governments through these national oil companies, and they're the ones that are not efficiently run. They're the ones that have too much debt. They're the ones with the politicians, bureaucrats, people in the military that are raping and pillaging the resources, the cash, the assets of these national oil companies and stealing more and more for themselves. And that's why these national oil companies cannot increase oil and natural gas production. So you're probably going to see, even if the real economy gets worse, even if the Fed actually does increase interest rates in March by a quarter point, based on supply and demand fundamentals for oil and for natural gas globally, you could potentially see even higher prices for both in the next 6, 12, 18, 24 months, because there are major supply problems in the long term for both. Unless demand totally collapses, and for natural gas, we're actually seeing the opposite. During the pandemic, according to research I've seen, there was actually a 6% increase in electricity demand globally during the pandemic. So despite the global economy having problems, despite China shutting down factories, despite shortages of coal in China, of natural gas in China, of shortages of natural gas in the United Kingdom and the European Union, electricity usage globally actually increased substantially by 6%. So that data point, that research actually shows me that natural gas and nuclear power are going to be two major sources of baseload electricity in the future. If there is a wide-scale stock market crash or correction, there would be good buy-the-dip opportunities for oil, natural gas, and uranium plays, because energy demand, especially for electricity, seems to be increasing. Especially as more people work from home and remotely, they're using even more power. They might be using less gasoline to commute, but they're using more power, more electricity at home than they normally would.